And I believe that we're live. So I'm honored to have with me the second and third best tour guides in our companies. I have Jared and John. How are you guys?
We're good.
Just a minor correction, Benoit. It's like the 30th and 31st best tour guides in the company. But other than that, yeah.
I got nothing to say.
Just before we went live, we were discussing kind of a positive topic about the signs of reopening here in New York City are becoming, more and more obvious. I was reading this morning about the market, how Boeing and Disney and that kind of stocks are doing very, very well, which is a good sign. People are having confidence towards the future, which is good, which means that we're going to get in the streets really soon and resume our tours.
Stock exchange is open.
I'm sorry?
And the stock exchange is
The
open.
stock exchange is open and people are on the floor. Social distancing. I didn't see. Did you see any live cast from the floor? No, I don't know if people are wearing masks or not on the floor, but they're 20 feet away on a bad day. So
right.
that's going to be fine. Also in the news, financial news that may influence a little our tours. The Federal Reserve is trying to avoid a second 2008. The president of the Minnesota Federal Reserve Bank has asked the banks to stop paying dividends to their customers so they can build up capital, which is another sign that we are preparing to reopen at some point, like putting money aside. If something happens, boom, we're going to be ready. Now, speaking of the Federal Reserve, which is, we talk a lot on our tours, but Jared, can you put us a little into context with the Federal Reserve? What is it exactly?
Sure, I'll be happy to, Benoit. This is, as you mentioned, something we discussed quite a bit on our financial crisis tour and even a certain amount on our Wall Street Insider tour. I would just start big picture by saying that most governments have two types of policies when it comes to money per se. The first type of policy is fiscal policy, and that's government spending. You may have heard of the phrase a stimulus package, right? That is government spending designed to stimulate the economy. For example, the U.S. government, the Army orders tanks, military tanks. That has to be built by a contractor. Which then has to hire employees, subcontractors, material suppliers. So in other words, the spending of the government, the fiscal policies stimulate economic growth through direct spending. But monetary policy, which is the second type of policies that most government have regarding money, is essentially the management of credit. In other words, what is the role or roles of the Federal Reserve? Well, first and foremost, they set the interest rate, the rate that the banks charge to take loans out, right? The interest rate. And what is monetary policy? Well, like in a nutshell, some of us are old enough to remember when we had high inflation. One of my colleagues actually purchased a home back in the late 70s outside of Pittsburgh. I think he told me he paid 18% interest in his mortgage. And so at that time, late 70s, early 80s, we had a very inflationary economy. Now, what is inflation? It's when the costs of goods and services exceed the rate of pay. And so that's where the economy is growing too fast. So the Federal Reserve actually raises interest rates during inflationary times to dissuade people from borrowing money, because they don't, if you want to borrow money, you want to borrow when the cost of that money is cheap. So if the economy is growing too quickly, the Federal Reserve raises interest rates to dissuade borrowing, which in turn dissuades spending, which then cools down an otherwise overheated economy. Conversely, for most of the last 10 years, interest rates had been at historic lows. That's the other end of the spectrum. When the economy is sluggish, when the economy is stagnant, when the economy is not doing well, the Federal Reserve keeps interest rates very low to encourage, to incentivize the borrowing of money. In other words, just as I said, you don't want to borrow money when the interest rate is high, you do want to borrow it when the interest rate is low. And so you are enticed as a business person to borrow that money at low rates. And that will then, once you borrow, then you spend, and that will heat up an otherwise dormant economy. So this is generally referred to as monetary policy, the tightening and loosening of credit, the raising and lowering of interest rates to help manage the economy. And so that's what we generally refer to as monetary policy. Now, I will just simply say that the Federal Reserve, at least in theory, there's a lot of people who like to talk about Federal Reserve conspiracies, but at least in theory, the Federal Reserve is not an executive branch agency. In other words, the president, who has the ability to appoint members to the board of governors of the Fed, the president does not sort of direct the Fed. That is the Fed is directed as an act of Congress. So in theory, the Fed sort of reports to Congress. But the purpose behind that is that every time you had an election, if it was an executive branch agency, then the president would try to implement policies that would boost reelection chances. So therefore, it's not independent. The Fed does report to Congress, but it's independent of executive authority, with the exception of the executive having the right to appoint members to the board of governors. And there's the other role of the Fed as well, and it's not easy, right? The primary role is what I would call monetary policy, but the Fed is to enact policies that promote stable growth and full employment, or the fullest employment levels possible. I mean, and that's not always easy, right? There are challenges to trying to tweak the economy, making sure we have steady growth, but not too fast growth or too slow growth, and that we have good employment levels. So that's sort of the overall mandate, is steady growth in the economy, managing good employment. And they do that through, deciding where to set the interest rate. So that's sort of the overview of the role of the Federal Reserve. I would like to ask John, however, there's something that's or let me just say one last thing, and I'm going to turn it over to John. If you want to learn about the Federal Reserve, look on your $1 bills. The $1 bills will have a letter, A through L, printed on them on the sort of left center portion of the front of the bill, $1 bills. And each of the letters designate, you can actually look very closely with your glasses or a magnifying glass. You look under the letter, and it will list the Federal Reserve Bank that it is associated with. So A, for example, is the letter associated with the Federal Reserve Bank of Boston. B is the letter reserved for the Federal Reserve Bank of New York. C is the letter reserved for the Federal Reserve Bank of Philadelphia. So on and so forth through the letter L, which is the Federal Reserve Bank of San Francisco, California. Now, it's often been said that of those branches of the Federal Reserve, of course, the Federal Reserve is headquartered in Washington, D.C., but it's got these regional banks. And of the regional banks, historically, New York has been the most influential, historically, I should say. And there's something that's very unique about the New York Fed, and I'd like to turn that over to John. And it regards a certain amount of precious metals in the Federal Reserve Bank of New York. And if John has anything to say about that, we do talk about it a bit on our financial crisis tour and the Wall Street Insider tour.
Yes, there's some precious metals in the Federal Reserve Bank of New York. In fact, the Federal Reserve Bank branch in New York is probably outside of obviously headquarters in Washington, D.C., the most important branch in the system for a number of different reasons. One of them being that a lot of the open market operations whereby the Fed goes out and purchases and sells federal government securities in order to influence interest rates, as Jared was describing, most of that work is done out of the New York branch, okay? That's one reason why it's so important. But there's another reason why the Fed is more important, which is what Jared was just sort of alluding to. And that is that there is a tremendous amount of gold in the Fed. Does anybody who's listening may have seen that Bruce Willis movie, Die Hard with a Vengeance, where a group of folks try to break into the New York Fed, all right? Well, they're after all that gold, all right? You can't do what they did in the movie, right? Because the gold is in a vault about 6 floors under the ground level, carved out of solid rock, all right? Hard Manhattan schist. You cannot break into the Fed vault out of the subway system, all right, as they did in the movie. But there's approximately sort of $280 billion worth of gold bullion down there, the largest reserve or repository of gold bullion in the world, from what we understand, all right? And what that gold represents, what it's all doing there, it was the gold reserves that backed up people's currencies when the world economy was basically based on the gold standard, right? Where gold reserves, physical gold reserves, actually backed up people's currencies around the world. And why was it all here in New York? Because people figured Wall Street, USA, right? New York City was probably the most revolution-proof place on the planet. And so that's why people stored their golds here. Right, their gold reserves. Now, you know, the world hasn't been on the gold standard for a long time, but, you know, transporting gold is pretty expensive. It's very heavy, so why move it? So it still sits in the basement of the Federal Reserve branch of New York, and there is a free tour that you can take in the Federal Reserve. The tour is absolutely fascinating, very difficult to get a place on it because it is free, right? But one of the highlights of the tour, the highlight, is to go down into the vaults. They take you down there and you get to see all that gold right in their shelves and gleaming at you and all that. Back in the day, the first time I took the tour was a long time ago. They used to let you in. They'd open the vaults, rather not the vaults. You go into the vault to see the gold. But they'd open the cages where the gold is actually stored, and they used to let you pick up the gold bars, right? What they made you put on with these titanium overshoes, because if you drop the bar on your foot, 28 pounds, you'd break your foot. So they used to make you wear these titanium overshoes. Apparently they don't do that anymore. I guess insurance costs just got inflated or something like that. But if you get a chance, anybody who's listening, if you get a chance to get on the tours, I said difficult to book, but try, you know, base your tour to New York if you're really interested in stuff, Wall Street, things like $280 billion of gold and seeing that. Base your tour on your ability to get into the free tour of the Fed and go do that, because it really is fascinating.
Yeah, I do apply several months in advance because it's like you said, it's very hard to get in. Now, there's a relationship between the Federal Reserve and some big old banker in New York that we talk about during our tours. That the bank is not there anymore. The bank still exists, but it's not at that place. And that's Mr. J.P. Morgan. That some people say that it might be responsible in small part, and I say maybe in a bigger part, in pushing people for the creation of the Federal Reserve. Anybody wants to take the topic?
Oh, I'd love to just
go ahead.
Chime in on that. But I just have to just say something about the movie Die Hard with a Vengeance. And John, that was a great description of the physical, vault and what it's like to go on that tour. The movie Die Hard with a Vengeance, which is a classic, it's the Die Hard 3. It's a classic shoot 'em up, bang 'em up, car chase movie. And it stars, as John mentioned, Bruce Willis and Samuel L. Jackson. They're both fantastic in that movie. But if you watch that movie, you'll never see the Federal Reserve Bank of New York, because nobody gets to film movies at the New York Fed. I mean, Steven Spielberg and George Lucas and, you name Martin Scorsese, you name a famous Spike Lee, you name a director, to use their influence. Nobody gets to film, movies over at the New York Fed. They are, and I say this with respect, the single most humorless group of people you will ever meet in New York City. The people at the Fed there.
They're cautious, Jared. They're not humorless.
they're a very, very humorless group. I would use that term, but they certainly get your attention whenever you go through their metal detectors two times now, I think. But to get back to Benoit's question, I would just simply say that not so much J.P. Morgan wanted the Fed or imply that. I would simply say that he was the cause. It was his, I wouldn't say abuse of power, but his tremendous power.
Yeah, his tremendous power, absolutely.
That caused people to say, we need to create something that eliminates his power. In other words, we had, two major financial crises, one in 1893, one in 1907. And who was the lender of last resort? Who did the bailing out at that time? Well, it was typically J.P. Morgan and his fellow bankers who did the bailing out. And they essentially were like financial kings. And they did the bailing out for profit, right? This wasn't altruistic purposes. They bailed out the economy. They in many ways controlled it. They were the financial kings. And people said, hey, we fought a revolutionary war to get rid of kings. Specifically, the U.S. Constitution prohibits what are called terms of emolument or royal titles, right? So we don't want kings, right? And so there became this movement that we need to create a Federal Reserve Bank, a central bank. And I didn't really mention this before. Monetary policy is carried out throughout the world, throughout the countries of the world, through their central banks, right? That's what we're talking about. Not private banks, central banks, in other words, government banks. And there became this feeling that J.P. Morgan and his fellow bankers have too much power. We need to recreate the base here and go back and get to a government centralized banking structure. And it was 5 years later in 1913, when the same year as the income tax was enacted, that the Federal Reserve Act was approved. But it was, I would say, approved in direct response to the power of J.P. Morgan and the concern of that enormous power. I would just simply also say that in terms of J.P. Morgan's particular influence in the, very good. I think, I'm sorry.
Whoa, Benoit.
Somebody did a great job putting up a cartoon that we actually show on our tour. That's
because
Morgan on the right.
Yeah, this cartoon, some say that is responsible for people actually starting to realize how powerful and how dangerous it is to have, all the financial power in one pocket. Because when you say financial power somewhere, you say political power. But Jared, please.
Well, no, just I thank you for doing that. Was that you, Benoit, who did that?
That wasn't me, Jared.
Oh, okay. Well, of course, in this cartoon, you have, for those of you who are unfamiliar, or those of you who are overseas, perhaps, you see a very small character in sort of the American flag suit there, and that's Uncle Sam. Now, Uncle Sam represents the American government, the cartoon character that represents the American government. The male embodiment, the female embodiment of the American government, or the America in general, you could say, is Lady Liberty. But the male cartoon embodiment is Uncle Sam. And you probably are familiar with the expression, if you have any age on you like me, Uncle Sam wants you, meaning Uncle Sam wants you to join the army. But this is a cartoon showing that you have this big giant J.P. Morgan on the right and the very small, powerless in comparison, Uncle Sam on the left. And so this was the type of political cartoon that got people's dander up, so to say, that we have to do something to take the power out of the private bankers' hands.
Well, don't forget also the boat has lost its mast.
Yes, that's true.
That's very important.
The boat what?
The boat lost its mast.
Heading towards the iceberg there too. The
yeah. Oh, yeah. That's a big rock in
That's
the
it.
back.
Exactly.
Yes.
But the one thing I just want to finish up by saying is that the humorless thing is, you know, in the financial crisis was 12 years ago now, almost 12 years ago now. Who did all the bailing out? All of us, right? As taxpayers through the government, right? Who's doing the bailing out in the COVID, you know, crisis, right? The government. All of us as taxpayers are doing the bailing out now. So for better or worse, you know, that's the situation now. But thank you so much for putting up that cartoon.
My pleasure.
Yeah, this is a great cartoon. I mean, I love JP's expression. He's looking at Uncle Sam. Don't worry, little fella. I got you covered. That's the message here, and that's exactly what people didn't want to see. What's kind of interesting is that the idea of a central bank and creating a central bank was not new. I mean, what happened in those financial crises kind of helped kind of incentivate people to start rethinking about what had been a very old idea, as a matter of fact. And that old idea came out of the brain of somebody we also talk about a lot on this tour, a guy named Alexander Hamilton. All right. It was his idea back in the 1780s to create a central bank type entity, and it wasn't implemented. His idea wasn't implemented until 1913.
Well, you're so right, John. The whole issue of a government bank, the whole interest, you know, of a centralized bank, has been one of great debate. People that are against the notion of a central bank feel that it leads to so much centralized power in government, you know, a strong centralized government, federal government I'm talking about. If you look throughout history, there have been great debates about whether or not we should adopt a central bank. There are people that are for less government control. Smaller federal governments have typically not been in favor of the Fed, but I think since 1913, it's pretty much established. But if you look at the history of the United States, it's been a great source of debate, just like, you know, it's sort of a specific issue between conservatives and people who are more liberal. You know, do we want a strong central government? Do we not? And one of the ways you do that is through a strong centralized banking institution.
Yeah.
Yeah, I remember in 2008, there was a debate about the Federal Reserve. People weren't, you know, in agreement with what was happening. And they were like, well, we can't let the Federal Reserve print all that money because it's one of the mandate of the Federal Reserves to print the paper money. Although the federal government has the exclusivity of minting the coins. So it's not that all the coins is the federal government and the paper money is the Federal Reserve. So people wanted at some points for the government to mint coins that are worth $5, $10, $20 in order to offset the power of the central bank. Remember, guys, about that debate?
That debate.
What debate? People were talking about it.
You know, I'll be honest with you. I don't remember the bills versus coin thing particularly clearly, and that may have been because I was asleep.
Well, if the one thing, getting back to what John had mentioned about taking the Gold Vault tour, to me, the highlight of that tour was actually not the Gold Vault, although it's pretty impressive to see, you know, a lot of gold. At the end of the tour, they let you go to their museum, and their museum has all sorts of exhibits. And one of this sort of gets to what Benoit was saying about coins versus paper currency. One of the roles of the Federal Reserve is what they call the Fed shred. And that's where they take old currency that's getting worn, and they literally shred it. And they have a big plexiglass enclosed case of shredded currency. And it's the museum itself is very good because it talks about the shelf life of our currency, like the $1 bill. Don't quote me on this, but I think it has a shelf life of something like 6 weeks.
Oh yeah, it's a very, very short one.
Short. Whereas the $100 bill has like a 2-year shelf life. They're in circulation for 2 years, whereas the $1 is in circulation for much less. And now I don't know if that has anything to do with the coins versus the currency issues or that Benoit is talking about. But I could tell you, it's fun to go in to that museum, which is just a fantastic museum, talking about the Fed and its operations, and see all that shredded money.
It is. It is. That's an interesting part of the tour. But you know, Benoit, when you mentioned the whole debate there and all that being part of, I think you said part of what was going on, the crisis in 2008. Was that?
That's right. That was in the right after the crisis. They said, well, maybe it's time to get some power out of the Federal Reserve and back in the government.
Right. One of the things that when you mentioned that, right, the hairs on my arm started to rise a little bit, right, because this is part of what we talk about on the tour as well. When you think back to 2008, 2009, of course, all that was happening and bubbling up, and the whole source of it and sort of ground zero of that crisis was right here on Wall Street, right? All the big investment banks and mortgage-backed securities and all that. And as things began to crumble, right, all of the investment banks started to have problems and all that. When they sought help from the Federal Reserve, right? And when they were in discussions about how to sort of shore up the financial system, they were having all those meetings with the Fed, not down in Washington, but right here in New York City, at the Fed branch in New York City, right? At the time, right, I was working in an investment bank, all right, which was on Wall Street. And at lunchtime, what we would do would be to come up to the corner, caddy corner from the Federal Reserve, where Brown Brothers Harriman is now, right? And we'd hang around there, right? Looking to see who was going into the Fed, right? And it could have been Dick Fuld from Lehman Brothers, the folks over there, O'Neill from, I think it was Stan O'Neill at the time, over at Merrill Lynch. All these people were having their meetings in the Fed, and that's where all the news trucks were posted up, right? All the newscasters would broadcast from that corner because they had a very good view of the entrance to the Federal Reserve, right? And when you mentioned the crisis in 2008, I don't know why, because I haven't really thought about this particular feeling, right, in a long time. But the hairs on my arm started to rise because I spent a career in finance, working in commercial banking and investment banking, and I was living through all this nonsense, right? I had nothing to do with mortgage-backed securities, but of course, what was in the process of happening in the world of finance was going to be a game changer, and everybody knew that. Game changer, a changer in the biggest possible way, right? And so we would go and hang out on the corner up there, talking to the newscasters and all that kind of stuff. And it felt like Armageddon was on the way, and of course, Armageddon was on the way. And that's what happened. Yeah. Hairs on my arm were rising, but I just want to share that with people because that's part of what we talk about on the tour too. The reality of being in the system when all this thing was happening and had everything to do with everything that was going on over at the Fed and all the plans that were being hatched there that came to fruition, obviously bailing out the system and bailing out all the big banks that are about to fail.
When I think of that period of time, that specific period of time in September 2008 that you're talking about, John, you talk about the hairs rising up on your arm.
Yeah,
I have to laugh a little bit. The Bellwether book. I mean, there's several wonderful books on the financial crisis. The Bellwether book is Too Big to Fail by Andrew Ross Sorkin, and it's very thick. It's very detailed, and it talks about these emergency meetings at the Fed, which are their specific initial purpose, of course, was try to save Lehman Brothers from bankruptcy. But I have to laugh a little bit. Jamie Dimon, the CEO of, I'm sorry, I'm drawing a blank. What is he CEO of, Jamie Dimon? Which
J.P. Morgan Chase.
J.P. Morgan.
J.P. Morgan Chase. I'm sorry. He was supposed to meet his future in-laws that night. It was his son or his daughter was engaged to someone, and he was supposed to meet his future in-laws that night. But he was called to the Fed Friday afternoon about, what was it, 5 o'clock, something like that. And I have to laugh because it's like all these powerful CEOs of these ginormous banks were like sent to the principal's office when Secretary Hank Paulson said, "Get your butt down here to the New York Fed." And, you know, Jamie Dimon can't even meet his future in-laws because he's been summoned to the principal's office, to kind of use that analogy. But that's what in other words, when a person that powerful gets, you know, treated like an adult schoolboy, you know, get your butt down here. There's something on the horizon, right, John?
Oh,
right, Benoit?
Absolutely.
There sure was. Well, I mean, the thing on the horizon, well, of course, we all know what happened. You know, it was such an unbelievable experience. I mean, we read the books, Too Big to Fail, The Big Short, all that, and we get an intellectual understanding of what happened, and we can understand all the players, and you learn how you know, collateralized debt obligations work and all that kind of business. So intellectually, you can kind of understand it, but sort of being there at the time was just bizarre. You know, I mean, Jamie Dimon getting summoned to the principal's office, right? Knowing that Armageddon was coming, you know, the hairs rising on your arm as you think about what happened. People losing their jobs and losing their minds, right? Because everything, oh, sorry, let me just turn this phone
If
off.
it's for me, I'm not there.
Benoit's not here, goodbye. You know, people lost their minds. I mean, banks went out of business when Lehman Brothers, you know, largest corporate bankruptcy in American history, when that place failed, right? And Jared and Benoit, I'm sure you remember the pictures of all the folks coming out of their offices with their boxes and everything. I mean, just absolutely shell-shocked looking. I don't know if you guys saw some of the, I'm not sure if this showed up on the news, I can't remember, but there were some scuffles and fistfights. You know, people who weren't in the real estate operations of Lehman Brothers, when the real estate people came out with their boxes, you know, people got into these ugly confrontations in front of the banks, right? I mean, people sort of losing their minds. It was that bad. I knew lots of people who lost their jobs and retirement security and all that kind of stuff, at least what looked like their retirement security. At that point, it was just absolutely mind-boggling. And, you know, when you have recessions like this, you have liquidity crises. At the time that, you know, when all this was going on in September, or maybe it was October of 2008, the investment bank that I worked at, I was on the municipal finance side. One of our biggest clients was New York City, right? And New York City was in the market trying to borrow short term, couldn't do it for 2 weeks. New York City, legit AA credit, largest city in this country, couldn't borrow short term because they couldn't get a letter of credit from a bank, right, to allow them to issue short-term debt.
A lot of banks stopped all their short-term credits. A lot of small businesses that need that as liquidity couldn't borrow at all.
The liquidity crisis, to end all liquidity crisis, it was absolutely stunning. Everybody freaked out. And this is part of the losing the mind things. And that's the reality of living through something like that, is really pretty extraordinary.
Well, just like $630 billion that disappear overnight with Lehman. And what was just incredible about it for everybody, for, you know, Main Street and Wall Street, is the fact it's the biggest bankruptcy before that was $100 billion. So it's right. Just magnifying, you know, just there was no increment, you know, between this and the other one. It was huge. It was just hard to imagine all that money disappearing, boom, over a weekend.
That's right.
Basically.
Yeah, it wasn't just Lehman Brothers. I mean, everybody, all the big banks.
But remember when Lehman Brothers was supposed to, well, it was clear it's going to bankrupt, and that they had that meeting at the New York Fed during the weekend, trying to find a solution. Don't forget that they had the bailout of AIG just before that, and there was incredible pressure on the Fed, on the government, to not bail out again. So that's why they ask all those big banks, it's your turn, because we can't do it anymore. Nobody could do it. Yeah. And, you know, Sunday night, I remember I was day trading at the time. Sunday night when the Asian market opened, guess what? big sucking sound, and that started the big, domino effect.
That's
coming
right.
down. Yeah.
How did that feel, Benoit? Day trading.
Oh, actually, the best money I ever made was, remember the date that the House was to vote on the first bailout, the first start, right?
Yeah. Mm-hmm.
Which didn't pass.
Yeah.
And I had a feeling that it wouldn't pass. So I was shorting the market. When that thing didn't pass, the market went. I had two contracts on the S&P, right? $50 a contract, $50 per point in profit.
Yeah.
By the time, and I would say like within 2 minutes, I was up something like over $2,000. And I got out because I couldn't, I was like, oh my God, that can't go like the other way.
You started to freak out.
Yes. But after that's like, okay, I can't touch it.
Yeah.
My stops are going, and that was just incredible that huge swings like this would happen, which, started to kill day traders like me, because now you can't day trade anymore because, you have those high frequency trade. Now, what's high frequency trading? There were some, but it wasn't like across the board in 2008, right?
No, not like now. Jared, do you have any idea what the percentages were or anything? But
of high frequency trading back in 2008.
Yeah.
No, I do not. What's the book? What's it called? Frequency Boys. By the same. Oh, I'm drawing a blank on it. There is a very good book came out about. Probably. I want to say 7 or 8 years ago now, that talks about the advent of high frequency trading.
Yeah.
And for those of you who are, I just sort of like to talk about big picture stuff. When you talk about technology and Wall Street, Wall Street is always pushing the edge, right? Or there's always some attempt for people in the know or the larger traders to get some advantage, whether that's to be the first in line when trades are going through, like in high frequency trading, or if you look back at the Great Depression, Joe Kennedy, of course, made a tremendous amount of money as a person in the know, so to say, that there's always been what I would call some level of preferential treatment for the bigger players, whether it be through the high frequency trading or through these algorithmic hedge fund operations that you see, or way back when. But that's what government does. Government responds to the creativity of these high frequency traders. The people that came up with these high frequency networks are sort of brilliant visionaries. And, the SEC and FINRA and the other regulatory bodies had to catch up and regulate thereafter. And this is what's always been the case on Wall Street. If you look at the Great Depression, the reforms of the Great Depression, the original, Glass-Steagall Act, which separated investment banking from retail banking, right? That was, I guess you could say, one of the New Deal pieces of legislation. Who did Franklin Delano Roosevelt draft to create all of the SEC rules on margin buying, et cetera? And that was Joe Kennedy, who was considered to be the greatest manipulator of the stock market, or one of the great manipulators of the stock market. And so I just think it's interesting, whether you're talking about high frequency trading or any of this algorithmic trading with the hedge funds, or even the stuff that occurred back in the turn of the century of the 20th century. There's always been people trying to get an advantage, and government is always catching up, trying to regulate that advantage. So I just think that's an interesting dynamic.
Yeah.
And people, if you come on our tours, you're gonna see those great buildings, the New York Stock Exchange, where J.P. Morgan used to have his bank, and the last bank on Wall Street, because they are leaving.
Yeah.
The last bank, which is Deutsche Bank, that's still there, still doing trading today.
We'll see how long they're there, won't we? They may not be there given their issues, right, over the last decade or so. As a matter of fact, I'm wondering whether they are going to be there through this year, because I think towards the end of last year, at some point last year, they talked about shutting down their entire Wall Street operations. I mean, and literally, because they've got other offices in Midtown, if I'm not mistaken, in
Shutting down or moving it to another location?
Moving it to Midtown. And also getting
like everybody else, yeah,
and shutting down some of their Wall Street operations. I mean, like literally, some of the their forays into certain financial markets. Yeah.
So we're going to have to modify the script.
There you go. There you go.
To the tour, and this is actually, if you come see our tours, it's something that you're going to see in the financial district. That right now the financial district is financial only by name.
Yes.
Because everything is being transferred and transformed into condos and a residential area, and it's changing a lot. Yeah. That's another example of, I would say, a lack of planning from the city, because they converted all those magnificent buildings into condos and co-ops, but they forgot to put schools and grocery stores around. So it was a big problem for the residents of the newly developed financial district for years. And now it's starting to get better.
Yeah. It is. There are a number. What they've done it's kind of interesting. On the tours, sometimes we get, as you guys know, for those of you who are listening online, school groups will come on the tours, right? And I always get a kick out of pointing out to the school groups that come where the schools are in the neighborhood, right? I mean, obviously you have a neighborhood that's now, due to high-speed trading and technology and all that, a neighborhood that, as Benoit says, is the finance district in name only. I mean, the stock exchange, 95% of the trades they do aren't done in that building. They're done on high-speed trading lines and all that kind of business. So with the neighborhood, basically all residential now, you got to have schools. It started off, as Benoit said, where there weren't enough schools, but of course now they've been building and ramping it up because so many people live there. But when the school groups come on the tours, when they see where the kids who live in the neighborhood go to school, most of the tour groups who come on the schools, right? Those schools that they're on or that they go to don't look like the schools in the financial district, right? Nice schools in nice country settings and all this. And you've got the schools in the financial districts that are several floors of some old banking tower or something like that, right? No playground to be seen, no soccer field, no football field, no tennis court, no nothing, right? So it's a whole different kind of reality.
Well, it's a neighborhood also that's seen so many transformations, or, over the past, quarter of century. I have a friend of mine, and we're going to have probably to end with this. I have a friend of mine who bought an apartment there, I would say like in the 80s or something like that, which he paid 3 times nothing for it.
Yeah.
And sold for a couple of millions just recently or something like that. He said when he used to live there, he says the neighborhood was so bad.
Yeah.
The financial district, that when all business closed.
Yeah.
And you say around 6,
yep.
you just don't go out, because it was a bad neighborhood. It's something that we talk also on the tours. So I'd like to thank you guys for another very enjoyable conversation. Thank you, Jared.
Thank you, Benoit. Thank you, John.
Thank you, John.
Jared. Thank you, Benoit. Always a pleasure. Always.
Let's do it again. And people, don't forget, we may not be on the street anymore, but we're still touring. Have a wonderful day.
All right. Thanks. Bye. Have a good day.